the price of oil? Could it collapse in 2018? Oil prices have recovered from the lows of 2015, but there is a reason to believe 2018 could bring another steep collapse in the price. U.S. oil production is expected to continue to rise and may even accelerate in the new year. At the same time, there is some temporary stability in the Middle East, which reduces the risk of production and supply issues. The final price lies firmly in the hands of OPEC, and whether they agree to maintain production caps. They agreed with Russia to extend production cuts until the end of 2018, but is it enough? And will the agreement hold through the year? U.S. oil expected to surge. It was the U.S. shale oil revolution in 2015 that first precipitated a collapse in the oil price. Crude oil prices ended 2015 below $40 per barrel, the lowest level since 2009, with average spot prices for Brent at $52 per barrel, 53% below the level in 2014. The recovery in the oil price since then has been mainly driven by OPEC cutting oil production and waiting for the oil glut to clear itself. Throughout 2016 and 2017, the markets have balanced themselves, with the price hanging around $65 per barrel in the last few weeks. But U.S. oil production is not stable. It is continuing to rise. In fact, U.S. oil production has soared more than 16% since mid-2016. One can expect that this will continue to rise over the next 12 months, and that production could even rise as much as 20% over the first half of the year. Firstly, U.S. shale oil companies continue to go from strength to strength. Many of the companies in the market have used the last 2 years to develop, experiment, and refine the new technology, which has now come online. That not only means that these companies are able to pump oil more quickly, but also more cost-effectively. Reserves that were previously inaccessible or not cost-effective are suddenly within reach of these companies. We should expect to see many more shale oil operations to start pumping over the first 6 months of the year. In fact, OPEC forecasts published in November showed that they expected the war between them and the U.S. shale industry to further hot up over the next 12 months and beyond. This growth is heavily front-loaded as drillers seek out and aggressively produce barrels from sweet spots in the Permian and other basins, OPEC wrote, referencing drilling activity in Texas and New Mexico. Second, the world should expect Trump to make energy security one of his key foreign policies in the new year. Trump has, of course, always been an advocate of the U.S. increasing its oil production, but so far he has been broadly distracted by domestic policy, tax cuts, and reforming Obamacare. It looks like most of those things have now passed, and he is starting to think seriously about oil production. In fact, over the last month alone, Trump has permitted ENI to drill for oil off Alaska, and the administration has opened the door for oil drilling off the U.S.'s East Coast. One can expect him to further put down the pedal in the new year. According to Bloomberg, Trump has ordered the Interior Department to write a new blueprint to auction off oil and gas rights off the East Coast. OPEC production cuts to end. An increase in oil production in the U.S. comes at the same time as conflict in the Middle East is starting to stabilize. According to some estimates, ISIS has lost as much as 98% of its territory since 2016. This means geopolitical risks to oil supply have eased substantially. Those two things, on their own, would suggest a price collapse or a steep decline throughout 2018, but the wild card is what OPEC will do. They could further restrict their own supplies to balance the market and hold up the price. But will they? It is unlikely. In fact, there is reason to believe they may do the opposite. In the face of oil price falls in 2015, OPEC and its leading member Saudi Arabia were slow to reduce supplies. Cuts were eventually agreed between OPEC's members and non-OPEC Russia, and an extension to these production restrictions were signed in November. The bloc, including Russia, has agreed to cut supply by about 1.8 million barrels per day. It is not clear this deal will hold for the whole of the year. Saudi Energy Minister Khalid Al-Falih has said OPEC would assess progress at the group's next regular meeting in June. The deal could fall apart then. Firstly, Russia has already shown that it is not wholly convinced the deal is beneficial to the group. It has expressed concerns that holding up the prices incentivizing investment in U.S. shale, which will undermine its own global position in the long term. In the face of Russian caution, the deal has been held together by the will and determination of Saudi Arabia. But that brings us to the second reason society should be skeptical about the deal holding throughout 2018. Saudi Aramco. Saudi Arabia will lose one of its main incentives to hold up the oil price by around Q3 2018, the float of Saudi Aramco. The IPO of the oil giant is expected to take place in the latter half of 2018, after some initial delay. The Saudi government has been keen to hold up the price of oil in advance of the float, so that it can maximize the IPO price and get as much money out as it can. After that float has taken place, there will be less of an incentive to hold the price firm, and Saudi Arabia may start to relax its more aggressive stance. At the same time, Saudi Arabia is going through a period of regime change, with power passing from King Salman to Prince Salman. The king's son has committed to modernizing the country's economy and prepare it for a life after oil. He has unveiled a bold vision for the country's tourism, tech, and entertainment industries. Of course, it is improbable that Saudi Arabia will wean itself off oil in the near future, but Prince Salman's determination to reimagine the country's economy shows that its economic policy will stand for more than just managing the oil price, as has been over the last few decades. Conclusion: overall, these things suggest that a collapse in the oil price in 2018 is possible, and perhaps even likely. The U.S. will ramp up production just as Saudi Arabia loses its determination to maintain higher prices. Investors will be watching things carefully. Alert! This is something the world has never seen before. This is something the world has never seen before. December 23, King World News. Here's a look at the jaw-dropping commercial short positions in the crude oil market. See 23-year chart below. 23-year chart, all-time record short positions in crude oil. Right as the oil bull sentiment shows extreme optimism, total energy hedgers also have all-time record short positions. King World News note: for the oil bulls, this is a major warning. Please keep a close eye on your crude oil and energy investments, and be ready to react if a major smash begins to unfold. For those on the sidelines, you may see cheaper prices at the pump in the not-too-distant future. The price of oil, could it collapse in 2018? Oil prices have recovered from the lows of 2015, but there is a reason to believe 2018 could bring another steep collapse in the price. U.S. oil production is expected to continue to rise and may even accelerate in the new year. At the same time, there is some temporary stability in the Middle East, which reduces the risk of production and supply issues. The $2 per barrel, 53% below the level in 2014. The recovery in the oil price since then has been mainly driven by OPEC cutting oil production and waiting for the oil glut to clear itself. Throughout 2016 and 2017, the markets have balanced themselves, with the price hanging around $65 per barrel in the last few weeks. But U.S. oil production is not stable. It is continuing to rise. In fact, U.S. oil production has soared more than 16% since mid-2016. Final price lies firmly in the hands of OPEC, and whether they agree to maintain production caps. They agreed with Russia to extend production cuts until the end of 2018, but is it enough? And will the agreement hold through the year? U.S. oil expected to surge. It was the U.S. shale oil revolution in 2015 that first precipitated a collapse in the oil price. Crude oil prices ended 2015 below $40 per barrel, the lowest level since 2009, with average spot prices for Brent at $52 not cost-effective are suddenly within reach of these companies. We should expect to see many more shale oil operations to start pumping over the first 6 months of the year. In fact, OPEC forecasts published in November showed that they expected the war between them and the U.S. shale industry to further hot up over the next 12 months and beyond. This growth is heavily front-loaded as drillers seek out and aggressively produce barrels from sweet spots in the Permian and other basins, OPEC wrote, referencing drilling activity in Texas and New Mexico. Second, one can expect that this will continue to rise over the next 12 months, and that production could even rise as much as 20% over the first half of the year. Firstly, U.S. shale oil companies continue to go from strength to strength. Many of the companies in the market have used the last 2 years to develop, experiment, and refine the new technology, which has now come online. That not only means that these companies are able to pump oil more quickly, but also more cost-effectively. Reserves that were previously inaccessible or